Now that the market has pulled back, it is time to assess one's portfolio and invest in recession-proof dividend stocks that guarantee safety of investment as well as increasing return on investment year after year. One of the safest investments to put your money in is Dividend Aristocrats, which are companies that pay dividends continually and increase their dividends year after year. In this video, I'll discuss the effects of a recession on an investor's portfolio and how, by employing simple strategies, an investor can recession-proof their portfolio while continuing to gain appreciation of their assets and get paid steady growing dividends income along the way. And don't forget to smash the like button before you continue watching this video, as it will really help out the channel grow to get this information out to the masses. Get ready, you are now entering the Academy. In economics, a recession is a business cycle contraction when there is a general decline in economic activity. Recessions generally occur when there is widespread drop in spending and adverse demand shock. This may be triggered by various events such as a financial crisis, an external trade shock, an adverse supply shock, or the busting of an economic bubble. Recessions are cyclical in nature, triggered by one or a few of the events mentioned previously. The last recession occurred during 2008-2009 when the financial crisis erupted, causing sharp declines in the stock market, where the S&P index dropped by a whopping 37%. The recession, bad news, is in full effect by the mass media, as the loom and gloom prospects of a recession is starting to rear its ugly head. One thing to understand is that recessions are cyclical in nature and part of the economic cycle of expansion and contraction. As can be seen in this graph, there is a continual cycle of economic expansion followed by economic contraction over time. The peaks are moments of expansion where there is rapid economic growth, the stock market is at all-time highs, for example, and the troughs show an economic contraction is occurring, indicative of a bear market. The phases of the economic cycle have been occurring for the last 100 plus years and will continue to occur. This is the nature of long-term economic expansion. As can be seen over time, the long-term trend shows economic growth. This is why over time, the S&P 500, for example, has significantly grown over the last 100 years and will continue to do so. Understanding the nature of the economy and recessions can be the greatest tool for the savvy investor. There are several interesting strategies an investor can employ to navigate the waters of a recession, also known as recession-proofing one's portfolio. The first strategy is reducing volatility in their portfolio. To measure the volatility of one's portfolio against the market, one can use the beta of individual stocks to gauge volatility. During economic recessions, beta could be your worst enemy. The definition of beta is a measure of the volatility or systematic risk of an individual stock in comparison to the unsystematic risk of the entire market. In statistical terms, beta represents the slope of the line through a regression of data points from an individual stock's returns against those of the market. The entire market has a beta of 1.0. If an individual stock has a beta of 1, then this means that its price activity is strongly correlated with the market. During a recession, if the market is down, there is a large probability that an individual stock with a beta of 1 or greater will be down as well. An individual stock with a beta of less than 1 indicates its price activity is less volatile than the market. For example, utility stocks often have low betas because they tend to move more slowly than the market averages. For a savvy investor, the first strategy is therefore creating a portfolio that is less volatile than the market with stocks that have low betas. The second strategy for the savvy investor is to diversify their portfolio across multiple industry sectors, asset classes, and regional. A truly well-diversified portfolio contains a healthy mix of fixed income assets, bonds and cash, as well as stocks in diversified industry sectors with companies that do business globally for regional diversification. The industry sectors include financials, utilities, consumer discretionary, consumer staples, energy, healthcare, industrials, technology, telecom, materials, and real estate. Selecting individual stocks from each of these sectors limits one's exposure to any one or group of sectors that may be declining, averaging out losses with potential gains in other sectors, thus minimizing overall losses. In addition to diversifying across sectors, focusing in on defensive sectors whose business models are the least affected by a recession historically because they provide essential goods and services that consumers continue to buy even during an economic downturn can be an added security measure to reduce volatility further. Historically speaking, consumer staples, healthcare, utilities, and telecoms have been the most recession-proof sectors. Their sales are least affected by the state of the economy since they sell essential products and services such as food, electricity, telephone, and internet services, as well as medicine. The low beta stocks mentioned previously all fit into these defensive sectors. In addition, selecting stocks that have exposure to global sales diversifies a portfolio even further by limiting dependence on domestic business exposure, especially during recessionary periods. The third strategy is to invest in dividend income stocks that have historically grown their dividends over time above inflation rates and consistently paid dividends over time. Most of these stocks can be found in the Dividend Aristocrats, which are S&P 500 index constituents that have increased their dividend payouts for 25 consecutive years or more. The Dividend Aristocrats' long-term record showcases the long-term superior effect of compounding dividends as well as the positive effect of a rising dividend payout on a portfolio's total return over multi-year periods. Not only that, but during recessionary periods, Dividend Aristocrats tend to outperform other growth stocks and dividend income continues to be paid out, sometimes with substantially increased dividend growth rates during these times. If dividends are reinvested during recessionary periods, dollar cost averaging at lower stock prices generates a compounding effect, increasing dividend income substantially, spurring massive wealth acceleration during these periods of uncertainty. Now, for our top 5 Dividend Aristocrats for a recession-proof portfolio, we have the following. The first Dividend Aristocrat is Consolidated Edison, ticker symbol ED, which is a utility company that is heavily undervalued. Currently near its 52-week lows with a beta of 0.15 and a dividend yield of 4.52%, Consolidated Edison makes for a no-brainer investment into a recession-proof portfolio. Not only does it meet our beta criteria, but it is in a recession-proof industry, utilities, and near its 52-week lows. There's not much more room for it to drop, and with major upside, along with a 4.52% dividend that will provide passive income as this undervalued stock continues to appreciate over time, makes Consolidated Edison one of the best investments out there. The second Dividend Aristocrat is Procter & Gamble Company, ticker symbol PG, which is engaged in the manufacture and sale of a range of branded consumer packaged goods. Procter & Gamble has paid out dividends for almost 130 years and has raised its payout for a whopping 63 successive years. The company's expected earnings growth rate for the current year is a solid 8.6%. Currently, Procter & Gamble is near its 52-week prices and has a beta of 0.42 and a dividend yield of 2.55%. Procter & Gamble is a great consumer staples dividend aristocrat to invest in for diversification and solid, steady dividend income along the way. The third Dividend Aristocrat is Abbott Laboratories, ticker symbol ABT, which is a healthcare giant with a market cap of well over $200 billion and has been in business since 1888. Abbott has paid a dividend for a remarkable 388 consecutive quarters, and the company has increased its dividend for 49 years in a row and will probably move into even more prestigious group of dividend stocks known as the Dividend Kings. S&P 500 members with at least 50 years of consecutive dividend increases later this year. Along with being a market leader, Abbott is well diversified in its product pipeline, covering everything from branded generic drugs to various nutritional products as well as diagnostic equipment and care. Abbott continues to see price appreciation through 2021 and has been steadily growing for the last 5 years. Currently sitting at $119 per share with a beta of 0.72 and a dividend yield of 1.51%, Abbott will provide great appreciation to a recession-proof portfolio in a greatly needed industry that is recession-proof as well. The fourth Dividend Aristocrat is Hormel Foods Corporation, ticker symbol HRL, which is a popular consumer brand that offers everything from branded chili and pepperoni to Dinty Moore stews, House of Sang sauces, Skippy peanut butter, and many other products you likely have in your pantry. In fact, according to company literature, more than 40 of the parent company's brands are number 1 or number 2 in their product categories. This reliability in sales translates into big reliability in dividends, as evidenced by the Dividend King's 5% dividend bump announced in November, its 55th consecutive year of dividend increases. Hormel has paid dividends in some form for almost a century, dating back to its start as a publicly traded stock back in 1928. Hormel's price has been pretty steady within the last year, but is unique in that it contains a beta of nearly 0. This means it is completely decorrelated with the S&P 500. With a dividend yield of 2.08% and steady price movement, Hormel provides a steady, reliable source of income during any recessionary periods in a greatly needed industry that is recession-proof as well. The final Dividend Aristocrat for a recession-proof portfolio is Colgate-Palmolive Company, ticker symbol CL, which is one of the more popular consumer staple stocks out there and has long been a standard of low-risk portfolios thanks to its stable operations. After all, people will continue to buy toothpaste and cleaning products regardless of whether the economy is up or down, and regardless of whether they are stuck at home because of quarantine or not. And like many other dividend kings, Colgate is a dominant global brand. Consider that the firm says it has a worldwide manual toothbrush market share of 31% and global toothpaste market share of about 40% as of the beginning of this year. Colgate-Palmolive's price has seen a bit of a dip lately, which presents a great opportunity for a buy. With a beta of 0.62 and a dividend yield of 2.33%, Colgate provides a great opportunity for further upside from a dominant global brand that will continue to pay appreciating dividend income over time. So there you have it. I've just mentioned 5 solid companies that even under a recession keep producing and generating sales. They may not be glamorous, but they are defensive by nature, and even during the 2008 and 2009 recession, for example, they kept paying and growing their dividends. These Dividend Aristocrats are a great investment that not only pay dividends, but fortify and recession-proof a savvy investor's portfolio. Investing in a well-diversified stock portfolio with stable dividend income producing assets can be the smartest and safest investment for those looking to create wealth over time even during recessionary periods. By employing the recession-proof strategies mentioned in this video, along with safe and smart investing techniques discussed in other 10X Academy videos, such as value investing, dollar cost averaging, and dividend reinvestment and diversification, one can create a low-risk dividend income flow that will grow over time and continue to pay income. Check out the links in the description on how to start investing in dividend income producing assets you can use to safeguard against any recessionary periods while starting your path toward financial independence and freedom. Thank you for watching the 10X Academy channel. Please make sure to smash the like button if you enjoyed watching this video. It will really help out the channel and the YouTube algorithm for bringing you more wealth creation strategy videos to the masses. And if you haven't done so already, be sure to subscribe to the 10X Academy. And don't forget to turn on the notification bell to be alerted on more passive income strategy videos. This is the 10X Academy.